Welcome along, everyone, to today's BTRM webinar. My name is Jeff Brown, and I've been involved with these kind of programs for many, many years in the educational sector within finance for over 20 years. Really proud to be a part of the BTRM. And today is a special one, actually. We've got Jill Cetina with us, who's going to be delivering the presentation. She's an extraordinary character with an extraordinary career. I won't go back all the way to the beginning of her career, but just to say that a little over 10 years ago, she managed a team of 15 as Associate Director at the US Department of the Treasury, conducting research and analysis that focused primarily on regulatory policy and potential financial stability risks in banks, insurers, asset managers, and other financial institutions. She worked there for a few years before moving on to the Federal Reserve Bank of Dallas, where she was Vice President for Supervisory Risk and Surveillance. She had oversight for 6 teams of about 40 people, with enormous responsibility over there. Again, she spent almost 4 years there before joining Moody's at an extremely interesting time in financial history, if you like, where she had responsibility for the US bank and government-sponsored enterprise rating team at Moody's during the 2023 US bank crisis related to the impact of significant monetary policy tightening on the US banking sector. She was Associate Managing Director there for US banks and GSEs. Before more recently, she joined as Executive Professor and Associate Director of the Commercial Banking Program at Texas A&M University. We are really proud to have her as part of the BTRM faculty. And I'm sure you'll find Jill's eloquence in her presentation, particularly with this topic area, really interesting. Jill, I'll hand over to you.
Thank you so much, Jeff. And you can hear me well?
Yes, very well.
Perfect. All right. So thanks. And I'm so grateful to collaborate with everyone on the BTRM faculty and team at this time. Particularly, it was just great when Murat asked me to join and get North America more involved. We're at a point where both in North America, we need to improve what we're doing in terms of asset liability management. That was evident to me after my time at Moody's, as well as I think creating a spirit of international collaboration is even more necessary today. And we're going to talk about this as relates to tariffs, which was obviously a big global shock. So without further ado, let me kind of get started on my talk. And the topic is tariffs, the global economy and market turbulence, and what do we make of all of this in terms of banks. This is basically what I'm hoping to cover in the presentation today. So just where we've been, where we're going, what does it mean? This is I am a mother of 2. This is my youngest favorite meme. And I thought it really kind of captured the spirit of this moment, which is certainly in markets today, there's kind of this sense of calm, right? But also this feeling like the house is a bit on fire. So let me kind of use that meme as a launching point for this talk. We came into 2025, and as some of you may know, I write a monthly column for the Certificate for Bank Treasury Risk Management. It's called Cetina's Treasury Talk. And coming into 2025, I was pretty divergent from consensus. Many people, and we'll talk about US growth forecasts, but many people were highly positive about the US economic outlook. You may recall the word exceptional getting tossed around for US economic performance. And my main message with this slide is that, if you really stepped back at the beginning of 2025 and looked at the administration's economic policy agenda, You would not have easily reached the conclusion that this was like, at least going into the beginning of the first half of 2025, that exceptional economic growth was going to continue. And so I've tried to lay that out here, but I think the biggest thing is that, going into the year, people focused on what felt growth positive about the economic agenda and tended to downplay things that were potentially growth negative or were associated with higher inflation. So let's step through these. When we look at some of the main planks of the administration's economic policy as they've articulated it, one of the things that they focused on was deregulation, and I think there's some potential for that to be growth positive, though we've not seen a lot so far in terms of deregulation. But that was one of the things that people focused on. People also focused, on tax cuts, but kind of a bit downplayed, which it's always been clear that the tax cuts would come later, right? But downplayed that before we got to the tax cuts, there was going to be a fiscal tightening, okay? And we've seen that play out in a number of ways. The DOGE initiative, the cuts in discretionary spending, that has actually proven to be bigger than many people anticipated, because we've also had the implications for contracts and grants from the federal government, and that's been important as well. But broadly, fiscal policy in the first half of the year so far has been tighter, and that's growth negative, okay? And I would say that I think fiscal is one of the top priorities of the administration. If I'm going to try to give some grace, to what the administration perhaps, and this is my inference, but perhaps is trying to achieve, they're trying to improve the overall fiscal situation of the U.S., which debt to GDP basically has been going somewhat parabolic. And I think a balanced read of the situation is that. And so it's fair to think about these things, but they pursued it in this, I'll call it first with the DOGE initiative, and then seemingly, trying to weaken growth in a manner that might get the Federal Reserve to perhaps cut interest rates, before we get to some tax cuts. And I'm going to come back to, my list here and talk a little bit about tariffs, because I think that tariffs need to be seen in light of this number one priority, which is fiscal, okay? The tariffs, I'm going to argue in this presentation, need to be understood as something that are viewed by the administration as a revenue source. And I'm going to unpack this further. But if you view it this way, then you're going to believe that they are going to become a permanent feature of what this administration thinks of as its economic policies. And there's many implications that flow from that we'll come back to. But tariffs are, in my view, intended to be a revenue source by the administration. And this is a way in which fiscal policy potentially tightens still further before we get to tax cuts. Immigration, just to kind of continue with that, there are other aspects of immigration policy that are, perhaps not related to economics, but I'm going to focus in on the economic implications of the immigration policy, which has been to dramatically curtail immigration. Almost all of U.S. labor force growth since COVID has come from immigration. That's just a fact. And labor force growth is crucial to overall economic growth. So the fact that we have had this really significant change in terms of immigration policy that's growth negative, from my vantage point. The other thing is that the energy policy that we are pursuing, we'll kind of come back to this, but shortly after the tariffs were announced, very shortly thereafter, OPEC cut prices, increased production. And I don't think that was a random accident. That seemed very, I'll say, coordinated and planned. And the drill, baby, drill took on a new meaning in that moment. right? And if you read things like the Dallas Fed Energy Survey, many oil executives were expressing, have been expressing the sentiment that things so far in terms of 2025 for oil and gas in the United States has been negative, right? So this has been, we have been self-sufficient. We got ourselves to self-sufficiency with some of the changes that went on in terms of the shale, industry in the United States. But that industry is under stress, significant stress. So these are all growth negative. Now let's turn to inflation in terms of this broad policy agenda that the administration laid out. For now, we've got some tightening of fiscal policy, though the tariffs, those price increases do go directly into the computation of CPI. Okay, so as those hit, and I'll talk on that a bit more, but we're talking about a fiscal policy loosening in the second half. So that would tend to kind of, in the second half of this year, undercut lower inflation. Deregulation is intended to increase capacity, lower inflation. But then immigration, reduced immigration, would tend to shrink the labor force, tend to be associated with higher inflation. Tariffs are higher inflation. And to some degree, this administration has also signaled that it is comfortable with a weaker dollar. Dollar depreciation is also, I would say, associated with higher inflation. So this is just to kind of do a scoreboard that if someone had kind of sat back and thought a bit about some of the timing of these policies and thought about growth, you wouldn't necessarily have reached some of the conclusions that were reached by the consensus. But I think it's somehow there was a focus on what people found maybe happy about, lower growth and, higher growth and lower inflation, and a downplaying of some of the other elements that got us to a consensus forecast that, basically is very out of step with the reality. Just to step through and now talk about tariffs specifically, because I do think it's important to see tariffs in this broader, I'll call it, landscape of the administration's policies. What the administration has announced, and this is even with, the 90-day moratorium, the 10% baseline tariff, the steel and aluminum, the very high tariffs on China. This is courtesy of Yale's, fiscal and budget lab. But basically, as of, just very recently, this is kind of where our tariff rates stood, and very consistent, with, high levels that we saw. You'd have to go back hundreds of years to be at this level of tariff in the United States. And of course, these are tariff rates that exceed those that we had back during Smoot-Hawley during the Great Depression. So this is, needless to say, a concern. Now, these are the tariffs that the U.S. has imposed on imports into the United States, U.S. exports. There have been some tariffs that countries like China, Canada, and the EU are now imposing on U.S. exports as a kind of countermeasure. So we've got that going on. This is just to give you a sense. We have, basically in terms of traded goods, 1.3 trillion with a T, in terms of both imports and exports that, are utilized in the United States. And then that's on the goods side, and then service sector exports from the U.S. We are the largest service sector exports. So as we think about where some of these, I'll call it acrimonies may go in terms of the global economy, I think it's important to keep, risks to U.S. exports of services in mind. But just to look at this picture very discreetly, this is showing the largest exporters to the United States, or the countries that are where our top imports from, and you can see here Mexico, China, Canada, Germany. This is just to give you kind of a sense of the countries that are potentially most impacted. This is just meant to sort of show, and I'm sure everyone just has felt this way since we've had the April 2nd announcement, but there's been a lot of volatility, okay, in terms of, we're retaliating on this, we're taking tariffs off on this, no, whoops, we're putting the tariffs back. And the point of this exhibit is to just really say, business fixed investment, companies' ability to invest and grow the economy. And business fixed investment is one of the core components of GDP and GDP growth. I'm showing that here in the white. Basically, we are not, as of Q4 GDP growth, business fixed investment was actually subtracting 20 basis points from GDP growth in Q4, but we've had just an unprecedented level of trade policy uncertainty, both with the April 2nd announcement and now with some of the, I'll call it volatility that come out in terms of the announcements. So making it very difficult, at least from my vantage point, to imagine that we're going to have robust investment driving some of the things that I think the administration would like to see in terms of reindustrialization in the U.S. economy. So just to kind of continue on this slide, trying to give a broader global perspective. Again, kudos to the team at Yale, but basically they've tried to model out what they think are the growth implications for not just the United States, but other economies. And you can see that for economies like Canada and China, who are subject to very significant tariffs and have significant trading relations with the U.S., these effects are potentially quite large. I want to come back to the connection that I was making between what I see as one of the top economic policy priorities of the administration and tariffs. And so let me do that in this slide. But as many of you may have been following, in addition to what's going on with the tariff policy, there has been discussion about the tax cut package for the second half of 2025 that would, needless to say, be discussed in Congress and voted on. And so that package, as I understand the most recent version of it, envisages about $5.8 trillion in U.S. Tax cuts, additional stimulus, and that we wouldn't see this tax package. My understanding is the very earliest that we could see it is early August of this year, and with also some risks that it comes even a little bit later than that. But I do think that the administration does view the tariffs as a part of the pay-fors for the coming tax package, and that they're trying to, implement the tariffs in some fashion with this in mind. White House advisor Navarro has stated that he believes that there's going to be $600 billion of revenue raised through the tariffs. There are many people who think that the numbers are going to be far less, and we can, we don't have to debate that. But this is foundational to my view that I think that certainly the 10% tariff, the baseline tariff, I think is going to stay with us. I think that de-escalating the situation with China is going to be challenging, given, I'll say, the retaliatory measures on both sides. And we'll see about some of the other tariffs, say, involving Canada and Mexico. But I think big picture, my point here is there are some, I think, in markets and also in banking circles who may hope that this is just going to die down or go away, or we're going to take all tariffs to zero at some happy point. And I'm just at this juncture quite skeptical of that, because I do think this is intended as a pay for. I think one of the things that's an interesting question is who is this U.S. government revenue raise really going to come from? And if the idea is that it's not going to fall on U.S. consumers, then that means that implicitly we have to think that companies have sufficiently high profit margins that they can cover that, okay? That they're going to be able to, pay these tariffs out. So the other point I think to think about is that just from a pure revenue viewpoint, needless to say, with very high tariffs on China and some countries with just the baseline 10% tariff, there's going to be some incentive to try to, migrate some activity to other countries, or perhaps reship it in a fashion to make it look like things that were perhaps produced in China are in fact coming out of a third country. And this has happened before with tariffs. So again, raising some question about whether the revenue that will be raised, whether these estimates are really perhaps fully credible. So just to kind of continue on, as I've stated already, tariffs are a tax. They're either going to fall on, basically foreign producers, U.S. companies that are the importers, or they're going to fall on consumers. And I think it's very interesting to note that since, the tariffs have been announced, since the administration launched this policy, that instead of having the dollar strengthen, we've had the dollar weaken, okay? And so that does, I think, increase the prospect for more, or in some way signal that more of these tariff costs or these taxes are going to fall on the U.S. economy, whether it's our companies or our consumers. I think, will be kind of a good by good, market by market type of thing. But that fewer of the less of the revenue is going to come out of perhaps foreign economies than perhaps originally thought. But basically, the goal here in some fashion seems to be that we want to reindustrialize. I will say that there are other ways we could have accomplished reindustrialization. If we were concerned about national security sensitive industries, you don't need tariffs to do that. You can use government procurement policies around defense to say everything in the supply chain must be produced in the US, and you're, I think, going to get to that same outcome. So this is why I do think that this, again, these tariff policies are part of fiscal, they're part of a revenue raise, and that those who kind of expect them to kind of go quietly into the night through negotiation, that's, in my view, unlikely. One of the things I think has been a mistake, and I've pointed this out in some of my BTRM columns going all the way back to January, is that the administration has been very focused on the size of U.S. trade deficits, and that's fine, that's understandable. But the counterpart, from a balance of payments point of view, to those trade deficits is that there's been significant over the years foreign investment in the United States, both portfolio investment and foreign direct investment. And that's what I'm showing in this chart. This is the net, the U.S. net international investment position relative to GDP, to U.S. GDP. And what this is it's measuring the stock of that foreign portfolio and foreign direct investment in the United States. So these are very large quantities of investments in the United States. And it's fine to want to perhaps pursue a different trade policy. That's every administration's right. But I think the way in which these trade policies have been pursued, needless to say, has produced a lot of acrimony. particularly among our allies, but even with China, in terms of just the approach. And so the concern and risk here is that, this investment, these investment flows, which have been quite large, that, they leave, and that they perhaps leave in an abrupt fashion. Trying to say that a key goal of U.S. policy is to just really radically reduce our trade imbalances, and then at the same time to say that we want foreign investment that's even bigger into the United States, is just kind of mathematically inconsistent with, general international economics and what we know about balance of payments math. And, if you're going to bring in the foreign investment, there's usually, a trade deficit associated with it. That's just how these things work in terms of balance of payments. So there's an aspect of this that I really question whether all of the pieces of this economic policy agenda were fully worked out in advance. By contrast, if we're going to reindustrialize the United States out of domestic savings, that implies a real curtailment of domestic consumption, and it probably implies higher U.S. interest rates to incent that savings to go into to investment. So again, if we're trying to reduce interest rates to help stabilize the fiscal situation and perhaps term out the debt, I kind of am not seeing how all these pieces, fit together as a whole in terms of the administration's policies. And, would love it if they were to put out a paper that kind of laid all of these things out and how they interact and work together. So at this point, without a paper like that, I'm left with the view that we have here a economic policy agenda that has a lot of priorities in it. I do think fiscal is the number one, but it's got a lot of priorities around immigration and tariffs and national security and a lot of things. And as anyone who's been in a leadership position knows, if you've got more than 2 or 3 priorities, you usually don't achieve them. Okay. And I pointed out, and I'm not going to step through all of these, but some, what I think of as some, I'll call it inconsistencies, internal inconsistencies with some of the administration's priorities. And again, it's not to say that trying to stabilize the U.S. fiscal position, improve the trade balance, be way more focused on national security are, those are very important objectives. I want to be clear that I'm acknowledging that. But the totality of the policies that are being pursued to try to seemingly achieve those ends are not fully internally consistent. That's, I guess, what I'm trying to say. So again, like I'll pick on the third bullet point for the bottom here, because I do live in Texas, and this does bother me. If we're worried about trade deficits, right, and we work out a deal to effectively have there be, coming from Saudi Arabia, a major increase in oil supply that makes the U.S. industry less economic, that's not constructive to the U.S. trade balance. It's just not. So, there are some of these things, and also if we care about national security, we should also want to be energy self-sufficient. But there's some other things that I've listed here. I'm not going to step through them all because I do want to leave time for questions. All right, so I think that we have, a very ambitiously pursued set of policies that are very different, that are in particularly on trade, and even in some ways the messaging about the role of the U.S. in the global financial system are just very different than where we have been for the last 40 or 50 years. And I think it's fair to say that we've surprised many people. We'll talk a little bit about, that in an aggregate economic sense, but from a policy viewpoint, we've surprised many people. And I'm listed here 5 reasons that I think we may have, unfortunately, and I very much hope I'm wrong on this. just to be clear. I'm not trying to be negative, but I do have 5 reasons that I think we may be kind of moving into a financial crisis type of situation. So what is my first reason? My first reason is that we've had a big negative asset price shock to the tune of about $10 trillion. And that the deleveraging that's associated, with that, and the shrinkage in credit growth, I think is going to be something that we're going to find. It's not happening immediately, but we're going to find in the coming months that is going to be a trigger for credit weakness. We've seen the rise in high yield corporate bond spreads. We're all starting, I'm sure, to read some of the articles about CLOs having challenges, concerned about where commercial real estate is going to go if the 10-year yield remains elevated. So these are all things that I think, starting to have credit issues is part of the picture. My second point here is that, and I'm going to show some slides subsequently on this, but basically we've had an enormous miss in terms of investor expectations on what was going to happen with GDP and inflation and what the likely reality is. And we saw, I'll call it fast money, trade what happened with tariffs, hedge funds, people who are very mark-to-market sensitive. But the big asset managers, I think, are a bit slower. They're going to go to investment committee. They've got to figure these things out. But they are invested for an environment that is not materializing and are going to need to make some changes. So I think those big portfolio shifts that are coming, and I'll talk in more detail on this, is another problem. Third issue is, I think that the U.S. Economic policy credibility has taken some hit, and this has the potential to erode the reserve currency status of the dollar and negatively impact the perception of the Treasury market. And you can see here, I've got a chart. Hopefully, everyone can see it well. But showing the 10-year Treasury term premia, which has risen sharply since the tariffs were announced. You can see here as well that this 10-year Treasury term premia basically moves inversely with the KBW U.S. Bank Index. So as the term premia rises, equity prices of U.S. banks fall, and when the term premia is low, that is supportive of U.S. bank equity prices. So in my view, there's a very direct connection here. But the reserve currency status of the dollar and the Treasury market are two sides of the same coin. And I do think when I was watching some of the price action, shortly after the tariffs, and we saw a really sharp rise, a real significant underperformance in long-dated inflation-adjusted Treasury securities. In my view, that potentially reflected sales from foreign central banks. The inflation-adjusted Treasury securities are an attractive part of the Treasury market for foreign reserve managers to invest in. Why? Because investing in the inflation-adjusted treasuries gives them some implicit foreign exchange hedging on their exposures to the U.S. And so that is nice. So when I saw this enormous spike up, we got up to as high as 2.8% real yield on the 30-year. I thought, wow, someone is trying to send their message back. Right now, I do think that we have a sense of calm in markets. Why? Because, we had a lot of things liquidated and there is a lot of current liquidity. But I do think that over time, as the administration really starts to collect on tariffs, those tariffs are going to act as an unexpected drain from the global financial system. Again, we're trying to figure out who's going to pay this tax bill that's just been presented that people didn't expect. Is it the consumer? Is it going to be exporters? Is it going to be U.S. corporates? But somebody's going to have a cash drain as the U.S. government takes in that cash and destroys it that effectively didn't expect it. And then the fifth thing that I think is really important is the fact that we really don't have a U.S., I'll call it official sector put or policy support here, which is something that we've had basically my whole working career in markets. We've always had fiscal policy and monetary policy have the potential to come in a strong way if there is a crisis and to act as an offset in a countercyclical fashion. I'll talk a bit more about why I think that's the case. All right, I want to come back to, I promised I was going to come back to how big of a miss this was in terms of people just reading the tea leaves incorrectly and focusing on, I'll call it the happy stuff, and ignoring things that could potentially really weaken the economy. And what I'm showing here is the consensus forecast from Bloomberg for US GDP growth, and going all the way back to the October survey just before the election. And so for 2025 in October, the consensus forecast was for 1.8% US GDP growth. And go all the way up until the end of February, people kept revising up their expectations for US growth. In fact, they revised it up by a full 50 basis points, right? Even though tariffs were in the mix and we were going through fiscal tightening, all of these things, it's just incredible, right? And even more incredible was when you look at the quarterly composition of this. Again, even knowing that there were going to be significant cuts to discretionary spending in the first half, we still had these economic forecasts in February that were talking about, well, the first half's going to be stronger than the second half. Just mind-blowing, right? So we've started to get into a little bit more rational place. And I say a little bit because, we still, now we've got, as of this is data as of this morning from Bloomberg, but the consensus forecast now for all of 2025 is 1.8%, which still is the same GDP forecast that we had back in October, despite all of the shocks that have happened in the economy and all of the, I'll say, risks associated with some of these economic policies. So needless to say, I think there's still more downward revisions to come. When I looked at, I'll call it the distribution of quarter by quarter forecasts in Bloomberg for US economic growth, Q3 at this juncture is the most negative. And you can see here that they're, even so, the median estimate for Q3 is still 1.5% GDP growth. So this is a deceleration. This is a worsening in the outlook, but people still seem to be hanging quite a lot on fiscal stimulus, I'll say riding to the rescue at some point in, or rate cuts riding to the rescue later this year in 2025. Just continue on. In terms of CPI, I think, look, we've also had some really big misses here and continue to have misses. So the consensus forecast for CPI still would put us, at 2.8% in Q2 versus what the bond market is telling us, that we're looking at something certainly north of 3%. And if you're looking at short-dated tip break-evens, I've got that sort of shown here in terms of the October 2025 tip, you're looking at almost a 4% break-even. So this is important. Why? Because, when inflation is above 3%, that 60-40 portfolio that many asset managers have, historically used, it breaks down. Using the negative correlation between equities and nominal bonds breaks down when inflation is high, and you need to have a completely different portfolio structure. So this is why I think that we've got big portfolio shifts still to come, because people got both GDP and particularly inflation wrong. we went into this event. This is a chart just shortly before the April 2nd announcement. And basically, volatility, which is the white line, the VIX, was completely disconnected from economic policy uncertainty. And so we had a major volatility event, get realized. We basically had volatility get liberated in terms of what happened on April 2nd. We've gone through this repricing, and I think it's still going on in terms of high yield corporate bond spreads, because when you both see a significant fall in equity values and a significant rise in equity market volatility, that increases default probabilities mechanically for corporates, and you should end up with higher corporate bond spreads. And of course, unfortunately, one of the ways in which companies respond to that is to begin to shed labor, which is a process that I think we will start to see in the coming quarters, unfortunately. But I think this portfolio reallocation process has much more to go. Again, people got GDP wrong, they got US exceptionalism wrong, they got inflation wrong, and there's a lot of change yet to come through capital markets. You may have noticed this, but on the day that we had the move up in 10-year Treasury yields, we had, of course, a very significant rise in the 10-year Treasury yield, got all the way up to 4.5. It's come off that a bit. But at the same time, I want to focus you in on the white line here in terms of an international comparison. The 10-year German Bund yield, has come way down. And I think it raises an interesting question. For a long time, people have said, well, there's nothing else, except the US dollar. It may be that we don't have a single thing that, in terms of an alternative to the dollar for a reserve asset that people transition to. It may be, gold and metal. It may be some cryptocurrency. It may be euro and bunds. I think people are going to try to piece it together. And if you read, I am a fan of Ray Dalio. If you read one of his books, he makes a point that there actually are historical examples of transitions from a reserve currency to, in kind of a balkanized way to multiple assets. Not many examples, but there are a few in history. So I think that's, I definitely took note of this, the decoupling, if you will, of the German Bund. In terms of currencies, right, we have had moves in gold that have been going on for a while, and that many people, have a tendency, I think, sometimes to be dismissive of. But the significant moves in gold over the last 2 years would certainly qualify. The IMF, in its very famous paper, Levin and Valencia, about global banking crises, Levin and Valencia developed a definition of what is a currency crisis in the context of banking stress. And if you were to apply that definition to the move in gold in US dollar terms, it is a foreign exchange crisis already, even before the tariffs. Now, when you look at the dollar, which is basically the top panel of this chart, what you can see is that we have had a sharp depreciation of about 10% since the beginning of the year. This is a basket, a dollar basket that looks at the dollar against a range of foreign currencies. And about half of that, or 5% of that depreciation, occurred after the tariffs. Again, dollar depreciation is unwelcome if we're trying to, in effect, have many of these tariffs be paid potentially through dollar strength, right? That's not what's happening here. In fact, we're seeing just strong signs across these markets of dollar weakness. And this gets back to my point about economic policies and credibility, that we basically since certainly since 1971 have lived in a fiat currency system without any backing across all of the major currencies by anything hard like gold or silver. And so trust and economic policy credibility is very, very important. This brings me to a concern which, if someone had asked me 3 or 4 years ago if I would have ever articulated this concern, I would have said probably not. But in light of developments, I am going to, articulate it, which is a concern that risks of a U.S. capital account crisis are growing. What does that mean? So if you're not a person, if you're someone from an emerging market, you probably know instantly what I'm talking about. If you're someone in an advanced economy who hasn't dealt with emerging markets, you may be less familiar. But basically, this is the idea of when you have significant foreign capital in your economy, and there is a loss of confidence or a dramatic change in economic conditions, and that capital moves out rapidly, you can have what's called a capital account crisis. And what are some of the dimensions of this? You have effectively a sharp depreciation of the exchange rate. You tend to have interest rates rise because there's been a withdrawal of investment capital from the economy. And so there's a need for interest rates to rise to sort of effectively pull capital out of or increase domestic savings. And in the emerging market context, it is not uncommon, and I've documented that here. I was rereading an International Monetary Fund paper on this recently, but it is not uncommon for there to also be banking crises. Now, in the context of emerging market banking systems, this is more common because of foreign exchange exposures, and when you have big exchange rate movements, that causes problems for those banking systems. But I think in the US context, the way in which this might transmit into banks is actually more through the interest rate channel, if something like this were to happen, where again, what we were starting to see with the rise in the 10-year yield, that could pose very significant challenges. Say if we were to get up to 5.5 or even 6% on the 10-year Treasury yield, that would be highly negative for US banks. So this is just to provide some context about this, but these types of capital account crises, at least in EM contexts, they tend to be rather long crises with capital coming out. That does a little bit fit my storyline that it's going to take time for portfolios possibly to adjust and withdraw capital from the US. People go to investment committee, but that these are the kinds of risks that could occur. And then you could have very significant exchange rate depreciation, which needless to say puts pressure on inflation and makes it difficult for the central bank to lower interest rates. One of the things that I wanted to emphasize, and I had in my 5 points, was that unfortunately, I think we are in a bit of uncharted territory in terms of official sector policy support in this environment. Why do I say that? For the look of it, we are going into, at best stall speed economic growth near term, something like maybe 1%, and elevated inflation, if you believe, what's kind of priced in terms of, inflation swaps and TIPS break-evens. And so this type of a stagflationary economic environment is the most difficult environment for any central bank. I do not envy my Fed colleagues, but I think it's challenging to expect the Fed to cut rates here. And I do think that the administration, if they had wanted lower interest rates, they probably should have persisted with just a mere tightening of fiscal policy and not tried to do some of these things with tariffs at this juncture. I don't think, I know that there are, from looking at Bloomberg, rate cuts priced in. At this juncture, I'm skeptical until we get to a really significant weakening in terms of the labor market. The labor market, as we know, will be one of the last things that goes. I do think as well that there's a risk that Fed rate cuts, depending on the environment, could be counterproductive. They could potentially exacerbate economic volatility. So that would be very unusual. Quantitative easing is something that people have talked about, that the Fed could come in and potentially buy long-dated treasuries. Certainly, the Fed's ability to do that is very significant. However, I think in a context where the market was effectively raising interest rates out of concern about fiscal policies, that might have a bad effect on the dollar. So certainly, the Fed can always choose, where long-term interest rates will be through QE. But there may be implications about the exchange value of the dollar that come out of that are unfavorable. So I do think that we are going to see, we have had a discussion going on for a number of months now about what's happening with Chair Powell and the Fed. So, Fed policy credibility and that transition is something that's, got to be handled very delicately, or we could see further rises in the term premia. I think fiscal policy options are very limited. I know that there were some comments made today by the Treasury Secretary about using debt buybacks. I think that, one's ability to buy back treasuries that are selling off and then issue new debt to fund that it becomes very circular very quickly. So I'm not sure I see that as a strong tool. The risk here is, of course, that the tax cuts that are planned and envisaged and that are significant, that when they happen, that we end up with a backup in treasury yields. And I think that is a real risk here. Supplementary leverage ratio relief, bringing this just closer to banks, is something that has been touted significantly by people, I will say, who are mostly not banking people, as something that's going to really dramatically change the treasury market. I'm skeptical. I'm skeptical that banks can really make very significant purchases, particularly of long-dated treasuries, in a safe manner. I do think that there is a risk that people are thinking about this. The U.S. did this in the 1950s. We did do this where we, removed treasuries effectively from bank capital by bringing in, through the Basel process, risk-based capital ratios. And, over half of the U.S. banking system's balance sheet was in treasuries in the 1950s, when debt to GDP after World War II was very high. The key difference, though, was that we had Reg Q and we didn't have money funds. And so basically there was, banks' deposit rates were set administratively by the government. And so we didn't have to worry about banks getting into a negative carry situation with treasury yields and their deposit base, like one would need to worry about today. So, when you look at this chart that I've got here on the right, in terms of, in yellow, U.S. primary dealer net positions, we have primary dealers who are incredibly net long the treasury market. They are have treasuries coming out of their ears. And we potentially have both foreign private and foreign official holders looking to offload treasuries. So, these are just some of the dynamics that are important. Now, what are some of the ways in which the unhappy scenario that I've painted could be wrong? It's always good to ask yourself, how could I be wrong? Well, what's a way in which it could be better than I thought? If we changed our economic policy approach, we're more consultative and collaborative with others, that might help us. If we are able to deliver stimulus in the second half without long-term rates backing up, that would be helpful. If the data, the hard economic data, comes in maybe less bad than people currently think, and sentiment improves and financial conditions ease in the U.S., okay, that would be helpful. If somehow banks are encouraged to buy treasuries, okay, might not be a sound thing to do, but maybe that could help. But, again, I think I've talked a little bit about why some of those things might not come to pass. How might it get worse? if you go back and you take a look at the series of events that led up to, and you know, it's hard to say these words, but the Prime Minister of Singapore has already articulated this, as has Ray Dalio. So I'm just drawing on their point. If you go back and look at history in the 1930s, when we last had very significant tariff increases, that was a period that, tariffs were, say, in the case of the US, significantly increased for Japan. There were investment restrictions put on Japan. Japan's access to the Panama Canal was restricted, among other things. And ultimately, this, of course, as we all know, produced more than just economic conflict, but it produced actual geopolitical conflict. So that would be, a way in which, as bad as the situation feels, it could get worse. Another way in which it could get worse would be, again, if we had something dramatic like an attempt to remove Fed Chair Powell, that would, I think, in my view, be a negative blow to confidence. And again, to draw back on the lessons of history, when things get really dicey, capital controls are also something that, history would tell us, when things get very challenging around outflows and foreign capital outflows that have been used. Again, not things that, these are all things that most of us have not seen in our lifetime, but like a longer reading history and looking at this context makes you think about it, I'll just say. So basically, what is kind of the key message here for what banks need to start to think about? We've got this rise in the 10-year term premia, and as much as it has risen lately, it could go so much further, right? If we were to look back at my top chart, which is the 10-year term premia in the 1980s, which was the last time that we had stagflation, the 10-year term premia at that time was hundreds of basis points, right? So we're sitting at 71. Not good, not liking what it does to bank stocks, all of those things, but it could get so much worse. Basically, when we think about the ultra low rate environment that we've been in, for much of the period since, say, the 80s, rates have been coming down. We just need to be mindful of the NII chase and kind of discounting the importance of EVE. So just really important to kind of keep on top of that. HTM, in this environment, buying a lot of securities, sticking in HTM, not being able to hedge is really quite risky. I hope I've convinced you that that rate volatility is alive and well and is likely to stay that way for a while. I am concerned, given that we've got a long span before we get to any even attempt at fiscal stimulus. Fiscal stimulus, as I said, may result in higher bond yields. But even if it doesn't, I think we're going to be looking at a lot of Treasury supply. Okay, so we started off with 7% U.S. budget deficit to GDP, and we're probably looking to add another 4 or 5 percentage points if we were to go into recession before we even get to any tax cuts. So we're looking at a 10% plus U.S. budget deficit to GDP. That's going to be a challenge to finance. And again, this is, I think, contributes to a concern about higher bond yields, to come. In this environment, while money markets are still calm and rates, yes, they've risen, but with the potential for some possible upward volatility, it's valuable for banks to evaluate, maybe thinking about some of that term funding. Again, I don't hope that we get into any type of capital account crisis, but some term funding of, say, 2 or 3 years would be kind of consistent with thinking about an insurance policy on that. And going really far out the curve, is a temptation that I hope people appreciate in light of my earlier comments, should be resisted. I made the point about that, official sector policy may not be able to provide its usual counter-cyclical help. That's all we know. That's all we've seen on most of our working lives in advanced economies, is that central banks and governments are able to step in. And what I'm trying to communicate in this presentation is that there is a risk that they may not be able to, or that if they do, it actually provokes an adverse reaction, okay? And so I think we have to recognize that some of the strategies that banks may have employed, expecting that there are going to be rate cuts and you can go and get contingent funding from the central bank at a low cost, may not pan out, all right? So this gets me to the next bullet point. You have to have strong liquidity. You have to keep that interest rate risk and market risk sensitivity, well controlled. Again, having superior capital in this environment, very helpful. Getting your workout function ready for again, depending on one's portfolio, it may have been quite some time since folks in the institution had to work out troubled credit. Again, it just depends on your region and what your bank is lending in. Thinking about stress testing to a 6% 10-year treasury yield and a stagflationary environment strikes me as important. If I had said this in January, people would have thought that was ridiculous, but I think in light of developments, that's not my baseline case, not the 6% anyway. Stagflation is, I think, a base case. But these are things that institutions should really, from a risk management point of view, start to analyze. SLR, I'll just say it very plainly, no matter what people tell you that you can own unlimited quantities of treasuries, don't go super far off the curve and don't do it. A friendly reminder that agency mortgage-backed securities are basically being short rate vol at a time when the move is basically at incredibly, move of course is a metric of interest rate volatility, and it's incredibly elevated right now. So you're basically placing a bet on rate vol. Be careful with that. Municipal bonds, I'm speaking here to US banks, but some US banks have significant concentrations of this. And there is a risk that as the government looks for pay-fors for the tax cut, that the income tax exemption is repealed. This would, needless to say, have a negative impact on the valuation of these muni bonds, something to think about. And then our scenarios, as I've demonstrated, basically huge miss in terms of most consensus economic forecasts that people would have been using on a weighted basis to develop their CECL estimates. And so, if you're not already working on that and revising that and thinking about what it means for earnings and internal capital generation, I would try to get going on that. Uninsured deposits, we all have, at least in the US, are unhappy memories from 2023 with Silicon Valley Bank. And the last time that we had a period of stagflation, which was the S&L crisis, we had much higher levels of insured deposits in the banking system. So I would get ready for, even if you feel very confident and comfortable with your institution, I would get ready for potential contagion risks from bank failures as we move forward in the quarters ahead. Bright spot. Can Professor Cetina find a bright spot? Okay, I'm gonna try to offer one as I wrap up, which is basically to say that given the what I've outlined, I do think that this environment where there's a look that the dollar is going to, maybe not in a sharp fashion, but certainly perhaps in a more gradual fashion than right after the tariffs continue to depreciate, does create some opportunities that we've maybe in the US not focused on as much in terms of international correspondent banking and potentially offering retail accounts in this country, the potential to hold foreign exchange balances. I know this is common in other countries. In the US, it's very limited, the number of US banks that offer that. And there would be a need to develop foreign correspondent relationships between foreign and US banks to facilitate that. So with that, I am ready for some questions. I know we've gone a few minutes over, but we did start a little late. And I hope this was helpful. There's a question China's holding the most investment in U.S. Treasury bills. What would happen if China started dumping it, and how would the USA tackle such a situation? Well, I said that I thought that there perhaps already was some foreign selling. And I do think that, you know, this gets immediately into the question of, you know, QE, potentially, not if you're getting rid of bills, but certainly if you're getting rid of longer dated treasuries, which is where I would expect it. So, you know, QE would be a potential offset, but again, depending on the reason that things were happening, that might actually might not instill confidence and might further dollar depreciation. You know, might increase inflation expectations. So this becomes some of the mix. Wendy's got a question after that. Do you envisage industrial automation offsetting the mundane jobs that no human would have expected to do, since we have technology and robotics that can take care of these duties long term? I believe there's a heightened focus on encouraging the best and brightest to come study in the U.S. From abroad. Meanwhile, DOGE is stalling some funding to review R&D in its recently traditional sense. So I think, Wendy, what you're trying to ask is, like, you know, what's the prospect for automation, you know, and whether we stay up the value chain. And I think this is an important question because, you know, when we tariff everything, some of that I don't, or I hope we're not trying to bring back. Some of it I don't think we can bring back. We're never going to produce coffee or cocoa, you know, in the United States. But I do think that, you know, the automation piece, it obviously is very capital intensive and it requires capital. So again, I guess I come back to my points about economic policy uncertainty making people less perhaps excited about investing. But I don't know if I captured your question well or answered it well. That was. All right. How do restatement to CPI and PPI data in 2024 show up in many of these charts? Well, this chart would be the final statements in terms of CPI and PPI. So anything, any changes that are made would be in these data. But I will say that, you know, in the realm of, I'll say, economic policy credibility concerns, the elimination of the advisory committees for both US GDP and CPI, the academic advisory committees certainly raised some eyebrows, you know, in terms of just having some independent advisors on US macroeconomic statistics. So Leo had a question. Could you envisage the current administration doing a reverse scenario to the 2008 banking crisis, where the administration calls the banks to try to prop up the treasury market and say that, yeah, I mean, that was kind of what I was alluding to a bit, is that, you know, be careful, you know, banks should be careful what they wish for in terms of changes to the SLR. You know, getting asked to deploy the balance sheet in a stress to buy long-dated government securities has risks. So it might be nice to actually keep that guardrail if you're the CEO of a large bank. Someone said, thanks for the slides on the impact. Regarding who bears the burden of tariffs, domestic consumers, domestic importers, I get, but how do foreign exporters bear any of the costs except indirectly? You know, I could potentially say to my foreign supplier, I'm not willing or not able or going to try to negotiate that we're splitting some of the tariff. if you want me to continue to import into the United States. I think some of this is going to depend on bargaining power and alternative markets, but does that help, Gordon? Okay, not seeing Gordon, but okay, thank you. Yeah. Richie asked, you mentioned USA exports, service exports are approximately $1 trillion. Is there a measure of service imports? I'm sure there is. I didn't have that one in my head. Fun fact, top US service export, well, maybe people would guess it. It's actually education. It's all of the people that we have, in US universities who are foreign students. And so some of the things, unfortunately, that are happening in terms of student visas may have a negative impact on that, which is unfortunate for students. All right, Rupert, what has been the impact of basis trade unraveling at hedge funds? Has this masked flight to safety? So I think Bloomberg had a nice piece on this, and I never want to completely discount the basis trade. I think it has had an impact, but I guess I put a bit more weight on, we've got a number of factors like the change in 60/40. We've got the fact that I do think that there has been some, this is again a personal view, foreign official selling, and that these are some of the things that have had more of an impact. But I did have in my slides the swap spreads for the 5-year for SOFR, and you can see that the swap spreads became more negative sharply. So if I were to pull my slides back up, and again, I'll make the slides available after this talk. But I think one of the things that's interesting is I do think there were hedge funds that were trading this idea, and this gets back to people being who maybe aren't banking people. I'll say trying to get too cute on some of these regulatory things. But my understanding is that there were people who were kind of trading a compression in that spread with the idea that when SLR was removed, right, that there would be, a movement of that spread from being very negative to more positive once banks were intermediating more treasury securities, and that in fact that the widening of that spread becoming more negative did put pressure on hedge funds. So certainly hedge funds were involved here, but I do think that there's some. The back end of the tips curve coming unglued was just monumental for me. If you look at where the 30-year tip got on a real yield basis, it got all the way back to 2001, which is almost the beginning of the inflation-adjusted Treasury program. Somebody just dumped that. Remarkable. All right, Laurent, good to know that you're on. It seems we are navigating the tax payment day without much turmoil, given the reduced ONRP and the potential to refinance more debt in the near term. How will this affect TGA and bank reserves? Is that where you're seeing fragility in the banking system? Yeah, I mean, I think, look, ONRP has come way down. We've got the Treasury, reducing its cash balance right now, which is helpful. I find it hilarious. We'll say this one, I'll call it, maybe snarky comment. I find it hilarious that everybody's so worried about who's going to buy treasuries and finance the treasury market, and the Fed did not see fit to just end QT at the last FOMC meeting. If this is such a problem, why do we continue to let the Fed's own balance sheet run off? And the Fed is asking the private sector to fund. And yes, I know they cut it in half, and they're only doing $5 billion a month in portfolio runoff for treasuries. but what they do in terms of runoff for agency MBS, in general equilibrium, it's still money that is drawn into aid to financing agency MBS that potentially could have funded the Treasury market instead. So that was a mistake on the Fed's part. If there's, a lot of what has transpired here, the Fed, this is about fiscal policy or other economic policies, but that I think is unhelpful. And I hope at the May FOMC meeting that they just end QT. So in terms of this, I think once we get to a place where we're past debt limit and people attempt to normalize the cash balance in the Treasury general account, then we're going to start to see the pressure on banking system reserves. And this is why it would have been desirable to have ended QT to just make sure that we don't end up, once that normalization happens in terms of the Treasury's cash balance, we don't end up with insufficient liquidity. I think also in this environment, the overall desire for banks to hold liquidity may have increased. And so again, I would, the FOMC really in May needs to slam on the brake in terms of quantitative tightening and just try to get to a stable balance sheet policy, which is probably going to entail them needing to continue to do a touch of QT because they're incurring losses on the balance sheet. So they have to offset the ongoing loss associated with these super low coupon securities that SOMA holds, which are yielding below the federal funds rate. So a long-winded answer, but yeah, I think this is a risk that's going to come into view, Laurent, as we get further on into the second quarter and the third. And it's unfortunate. It's probably at this point, the Fed's only 2025 policy mistake thus far, but the policy mistake is to have not stopped QT in March. Other questions? All right. Well, Jeff, I don't know if you wanted to.
Jill, thanks very, very much. That was extremely interesting and some amazing points of view. We do run these webinars every month, and they're always extremely topical. So, feel free to join us whenever you want. I really hope you found this useful. I know I did. It was gripping. I found it gripping in probably a topic which is the most prevalent in the world today. So Jill, thanks very much for your expertise. Much appreciated.
Yeah, you're welcome. And I very much, I'll be honest, I very much hope that I'm wrong.
Yeah, in terms of a positive outlook. But hey, let's see what happens. And thanks very much, everyone, for joining. Thank you for the thank yous. And a recording will be made available. Bear with us on this one. It'll either be later this week or early next week. And we'll send a PDF of the slides as well. So all the best. Enjoy the rest of your day and talk to you soon. Take care. Bye.